There are so many different ways to contribute to super that it can be confusing to know what's best for you. In this short video, Kate breaks down the differences between the two main categories, non-concessional and concessional contributions. Please remember this information is general in nature and doesn't take into account your own situation.
There are two main types of super contributions that you can make, and they're called concessional and non-concessional. Concessional contributions come from your pre-tax income, or you claim a tax deduction for them. As a result of that, you need to pay contribution tax on the way into super instead of your normal income tax, and that's at the rate of 15%, which for most of us is less than the income tax rate we would normally pay, and that's one of the incentives for putting money away in super. If you're a high income earner, it's important to know that there might be more tax to pay on your contributions later, which is called Division 293 tax. And that applies if your total income for Division 293 purposes, plus your concessional contributions, is more than $250,000 for the year. There's an annual cap on concessional contributions, which does go up from time to time. The cap applies per financial year, so that's to July to June. Many of us can contribute more than the standard cap by using a measure called carry forward. That applies if your total super balance was less than $500,000 on the last 30 June, and you didn't use up all of your concessional cap space in any one or more of the 5 previous financial years. Concessional contributions are made of 3 main types, which are employer contributions that your employer is required to pay for you, anything you choose to salary sacrifice to super from your wages, and any personal contributions you put into the system that you claim as a tax deduction. On the other hand, non-concessional contributions come from your after-tax income. That's money you have in your bank account you've already paid your income tax on that you're not going to claim as a tax deduction. Because you've already paid your income tax, there's no contribution tax on the way into the super system. The annual cap for non-concessional contributions is 4 times the concessional cap, and it goes up in line with the increases to that. For many people, you can actually contribute more using a measure called bring forward, and that allows you to put in up to 3 years worth of contributions in one go if you don't contribute anything more in the following 2 financial years. People with very high super balances are not able to do that, so it is important to check. Also, if your total superannuation balance is $1.9 million or more on the last 30 June, your non-concessional cap is 0, and you cannot make this type of contribution in the current financial year. Non-concessional contributions are 2 main types. They are personal contributions you make to your own account, or contributions that you put into your spouse's account, which is called a spouse contribution. Either way, all those amounts count towards the same annual cap, but that is per person. So if you contribute to your spouse's account, you're using up your spouse's cap. And if you contribute to your own account, you're using up your own cap. There's some really great education available on SuperGuide for our members to learn more about these topics. First of all, if you're a higher income earner, you might want to have a look at our article on the Division 293 tax, which explains that in detail, and you can work out if that's something that applies to you. You can also learn more about that bring forward rule for the non-concessional contributions, and you can learn more about how carry forward works on the concessional side that can allow you to put in more than those standard caps.
SuperGuide members can access an extended version of this video, which breaks down steps you can take to optimize your super contributions. Join SuperGuide today to boost your super savings so you can be a superhero when you retire.